channel.
Silicon Valley Bank, a financial institution once considered a stalwart of the tech industry, has collapsed suddenly, sending shockwaves across global financial markets. The run on the bank occurred over 48 frenzied hours as customers pulled out their deposits, ultimately leading to the bank's downfall. The bank's problems can be traced back to its investment decisions, which led to an idiosyncratic balance sheet composition that major diversified banks like JP Morgan, Bank of America, or Citigroup don't have. But the bank's collapse was triggered when it announced a loss on the sale of securities and revealed plans to raise $2.25 billion in new shares to plug the hole in its finances. The U.S. federal government has stepped in to guarantee customer deposits and has shut down Signature Bank, a regional bank that was also on the brink of collapse. This intervention has calmed investors' nerves about a broader banking meltdown. However, the aftermath of SVB's downfall continues to impact startups and workers who relied on the bank for funding and salaries. According to YCCO Gary Tan, a third of Y Combinator companies won't be able to make payroll in the next 30 days. This unexpected mass furlough or layoff is a nightmare for most startups, especially since the sales force can't make sales if they're not working. The collapse of SVB has left a profound impact on the tech industry and beyond. It's a stark reminder that even the most innovative and promising companies can falter due to a single mistake. In the wake of this catastrophe, many are left to wonder what the future holds for the once vibrant Silicon Valley. Silicon Valley Bank was a crucial institution that served the startup and venture capital-funded tech world, primarily providing loans to technology startups. However, the bank's collapse was triggered by a run on the bank after the U.S. Federal Reserve raised interest rates, scaring away potential investors from the institution. The higher interest rates made private fundraising more expensive, leading some Silicon Valley Bank clients to withdraw their money to meet liquidity needs. This led to the bank seeking ways to meet customers' withdrawals, ultimately culminating in its collapse. SVB was also heavily invested in government bonds that performed poorly, further adding to its vulnerability. As higher interest rates caused the market for initial public offerings to shut down for many startups, investment in tech slowed. This put the bank in a more challenging financial position since it relied on tech startups as its primary customers. The collapse of Silicon Valley Bank highlights the end of an easy money era and raises concerns about the resilience of our banking system. However, President Joe Biden reassured the American public that their deposits would remain safe and that the banking system is far more resilient than it was during the 2008 financial crisis. It's important to note that Silicon Valley Bank's collapse is not an isolated incident but rather a symptom of a broader issue. The easy money era that fueled the growth of many startups is coming to an end, and companies must adapt to survive. As the tech industry continues to evolve, it's crucial to have a banking system that can withstand shocks and support startups' growth. The collapse of Silicon Valley Bank did not happen overnight. Warning signs had been present leading up to its downfall. The bank's problems can be traced back to its earlier investment decisions, where it had invested in risky assets that were no longer attractive when the Federal Reserve started raising interest rates to combat rapid inflation. This left Silicon Valley Bank in a precarious position, and it had to sell securities at a loss and issue new shares to plug the hole in its finances. The announcement of these actions triggered a run on the bank, with depositors trying to withdraw $42 billion in deposits. Experts point out that red flags at tech lenders like Silicon Valley Bank could have been spotted if banking rules had not been weakened. Politicians and bank lobbyists fought hard to lower risk management requirements for banks under $250 billion in assets, which meant that Silicon Valley Bank was not required to disclose how much it had in high-quality liquid assets to help cover net cash outflows in a period of stress. In conclusion, there were warning signs leading up to the collapse of Silicon Valley Bank. The bank's investment decisions and lack of liquidity made it vulnerable when interest rates started rising. Additionally, weakened banking rules made it difficult for regulators and investors to spot red flags at tech lenders like Silicon Valley Bank. It's essential to reevaluate and strengthen these rules to prevent future bank collapses and protect the economy. That was today's video. We hope you enjoyed it so much. Thanks for watching, thanks for subscribing, thanks for sharing, and thanks for being here and helping to make this YouTube channel a reality. Goodbye and until the next one.